So now that we've discussed the entry that was based primarily upon the BOJ intervening, the expectation that we would see the BOJ intervene, and then also couple that with that 76 major psychological level, let's talk about the management here. Now, I think we have to discuss the fact that this was set up on the daily chart. That's the first thing I think we have to make part of the conversation. The second part is, how far below 76 would I be willing to let this trade go? And you have to really look at it in two ways. One is you've got to understand that a longer term time frame is, generally speaking, a riskier time frame. And here's how I measure risk. Let's talk about risk in the way that I'm discussing it. Risk is the moment you are in the trade, you are now embracing and managing risk. You've accepted it. So the longer that I am in a trade, the longer that I expect to be exposed to this risk, again, being in a trade, the riskier I think the trade is. So a trade to me, part of the risk is the length of time that I am in the market. And if I'm on a daily time frame, each candle is going to take 24 hours. So we're going to assume that I'm going to be in at least probably one day, maybe longer. So how do we take something as subjective as the fact that we're on a longer term time frame, therefore means more risk? I think the easiest way to identify a lot of that risk is to look at the tendencies of that time frame. And for that, let's hop on over to the power stats. So I'm looking for the dollar-yen search results here. I have my search results, and by the way, this is the AutoChartist platform. I'm going to my specific search results, and once I pull up the dollar-yen, you'll see that I can actually look at the price movement analysis for this pair. I'm going to click on this green View Analysis button, and you see this graph that pops up. Let's zoom in a little bit here. So there's three tabs that I can look at. And again, what we're trying to do here is understand the risk of the daily chart from a historical context. So when I look at the price range forecast, this particular study is updated every 15 minutes. And it gives you an expectation for what kind of price movement we can see over the next 15, 30, 60 minutes, 240 minutes, and 1440 minutes. And you'll notice that the anecdotal kind of way that we started this conversation of a longer time frame presenting more risk because of potentially more price movement is also, it also bears out visibly here. You can see the wider price range expectation versus the shorter term time frame. Given 15 minutes, our expectation, minus economic report releases increasing volatility, minus unforeseen events increasing volatility, just generally speaking, a 15-minute time frame is simply not going to have the price range of an entire 24 hours. Of course, it's the 24-hour or the daily chart that we have to focus on here because of why. It's the daily chart that I'm setting the trade up on. So look at the range here, 77.05 up to 78.46. That's the current price range, but I'm going back a little bit to the point where I want to understand what type of movement I could get per day. That's one way of looking at it on average. I can even break it down to which day of week, and I can look at the movement per hour and understand from a risk standpoint what hours of the day are more likely to have the wider price range versus the narrower price range. So this is something, admittedly, we're going back in time, but this is something that you could look at right at the moment of entry and say, okay, what is the price range today, going back to, say, the 24th, when I started this trade, and look at what the price range expectation could be. Now, this is probably a pretty good general look, and you can see right off the bat, this is about 140 pips, right? So that's a pretty wide price range in terms of how many pips this pair could move over the course of 24 hours. What else do I want to consider? I want to consider, and I'm going to go back to the charts for this. The other aspect I'm going to consider is what had the ranges been up till then. Now, the 140 pips we're seeing now is obviously being influenced by this giant candle here. So before that, and again, what I'm trying to encourage you to do is look at the power stats before the trade, because I can tell you, because I was looking at it at the time, it was much narrower. We know 140 pips of daily range is not that typical of this pair. So the power stats is reflective of what we had recently seen. Up until then, it had been pretty quiet. So two things. One, I could look to other major psychological levels, like the 75-50 area. I could look at the overall ranges we have been seeing in terms of the high to low to get an idea of what kind of price movement we could see, and therefore also what kind of price movement I'd be willing to see below the 76. If we get below 76 by 20 pips, I'm not that concerned. Okay, I know that the typical price range could see tests of 76 and leave behind wicks below 76. So on a daily chart, is it too much to say that 50 pips is too much risk for a pair that could move? Let's take a look at a range here. Okay, here's one range, and the high was 76.31, the low was 75.70. So 75.70 is 76.31. So call it, right here we have 61 pips. And this is a pretty average candle, as you can see, 61 pips. So is my saying a 50 pip risk is out of line for the kind of range we would see? That's what I'm talking about here. I'm not using a dollar amount. I'm not using a fixed pip amount. I'm trying to use support and resistance, so a major psychological level, and the typical price movement of this daily time frame. So at that point, you can step back and say, can I afford 50 pips? So it's not a matter of making an artificial stop loss. It's more about looking realistically at price movement ranges, at the current mood of the market, at significant support and resistance levels like psychological levels, and then ask yourself, can I afford to actually trade or enter this trade, engage this market based upon its mannerisms right now?